You think you're a rational investor, but when you see INTU down 21%, in a single day, something primal takes over. Your chest tightens. Your mind races. Should I sell? Should I buy more? Am I missing something everyone else knows? This isn't rational thinking. This is panic dressed up as analysis. Right now, as I record this, Intuit has cratered 21.16%. Over $300 billion in market cap gone. And somewhere, thousands of investors are making the same catastrophic mistake they always make. They're treating a stock price like an emergency. They're confusing volatility with crisis. They're about to turn a temporary decline into permanent loss. Here's what's happening in your brain right now. Loss aversion is firing on all cylinders. The psychological pain of losing money is roughly twice as powerful as the pleasure of gaining it. So when you see that red number, negative 21%, your amygdala doesn't care about fundamentals. It doesn't care about long-term value. It screams one word: danger. Then FOMO kicks in, fear of missing out on the way down. What if it drops another 20% tomorrow? What if I'm the fool holding the bag while everyone else gets out? What if there's news I haven't seen yet? Your thumb hovers over the sell button. Your rational mind knows this might be wrong, but the emotional mind is louder. It's always louder. This is exactly how wealth gets transferred from the emotional to the disciplined, from the reactive to the philosophical, from those who trade on feelings to those who invest on principles. And today's crash? It's not a crisis. It's a classroom. But before we dive deeper, you need to meet someone who understood the psychology 2,000 years before modern markets existed. Epictetus, born a slave in ancient Rome, freed to become one of history's greatest teachers. He never owned stocks, but he understood something more valuable than any portfolio. He understood the human mind under pressure. Epictetus taught a principle that every investor needs tattooed on their consciousness. Wealth consists in not having great possessions, but in having few wants. But more importantly for today's lesson, he said this: it's not things that upset us, but our judgments about things. Think about that while staring at INTU down 21%. The stock price isn't upsetting you. Your judgment about what that stock price means is upsetting you. The number is neutral. Red is just a color. 21% is just mathematics. But your mind creates a story around those numbers. A story of loss. A story of mistakes. A story of being behind while others get ahead. Epictetus would look at today's market and ask one simple question: what can you control and what can't you control? You cannot control INTU's stock price. You cannot control whether it drops another 10% tomorrow or recovers 15% by Friday. You cannot control the algorithms, the institutional selling, the momentum traders, the headlines, or the fear. But you can control your response. The crash isn't the event. Your reaction to the crash is the event. Your portfolio balance isn't your identity. Your net worth isn't your self-worth. The daily fluctuations of stock prices aren't verdicts on your intelligence or your future. They're just fluctuations. This is where most investors fail. They mistake the map for the territory. They confuse the stock price with the business. They treat portfolio volatility like personal emergency. Epictetus understood something that modern behavioral finance is just catching up to. The obstacle is the way. The difficulty is the teacher. The crash is the opportunity. So let me show you how a Stoic investor thinks about days like today. First, the Stoic investor has already decided what they cannot control: stock prices, market sentiment, other investors, emotions, earnings surprises, analyst upgrades and downgrades, economic headlines, political uncertainty, global events, interest rate decisions. None of it. You control none of it. What you do control is your investment thesis, your time horizon, your risk tolerance, your buying and selling decisions, your emotional responses, your learning process, your preparation for volatility. That's it. That's your circle of control. When INTU drops 21%, the stoic investor doesn't ask, "What should I do?" They ask, "What has fundamentally changed about this business?" If the answer is nothing material, then the stock price is just noise. If the answer is something significant, then you evaluate based on facts, not emotions. Second, the stoic investor treats volatility as tuition for a wealth-building education. Every crash teaches you something about yourself. Are you investing money you actually need? Are you taking more risk than you can psychologically handle? Are you confusing speculation with investment? Are you checking prices too often? Are you making decisions based on fear or greed instead of analysis? Today's INTU crash is asking you these questions. What are your answers? Third, the stoic investor understands that extraordinary returns require ordinary discipline during extraordinary times. When everyone else is panicking, that's not the time to panic. That's the time to apply your principles. The market rewards those who can stay rational when rationality is scarce. Here's the framework. When you see a stock down 20%, you ask 3 questions. 1. Has my original investment thesis changed? 2. Am I investing money I can afford to lose? 3. What would I do if I couldn't check the stock price for the next 5 years? If your thesis hasn't changed, if you're investing appropriate money, and if you'd hold for 5 years, then today's price is irrelevant. It's just volatility doing what volatility does. But if any of those answers concern you, then the problem isn't the stock price. The problem is your strategy. The stoic investor also understands opportunity cost. While everyone else is focused on what they're losing, the disciplined investor is focused on what they might be gaining. Market crashes create discounts. Panic creates opportunity. Fear creates wealth transfer from the emotional to the rational. INTU down 21% might be expensive at these levels. Or it might be on sale, but you can't determine that while your amygdala is hijacking your prefrontal cortex. You can only determine that with calm analysis based on business fundamentals and long-term value. This is why the stoic investor practices negative visualization. Before they buy any stock, they imagine it dropping 20, 30, 50%. They ask themselves, how would I feel? What would I do? Can I handle this psychologically? If the answer is no, they don't buy the stock. If the answer is yes, they're prepared for days like today. Epictetus said, "Every art and every faculty contemplates certain primary objects." The art of stoic investing contemplates one primary object, building long-term wealth through rational decision-making during irrational times. Today is one of those times. So here's what you do right now. Close your brokerage app. Step away from the real-time S. Take 3 deep breaths. Remember that you are not your portfolio. Your worth is not your net worth. Your intelligence is not measured by daily stock movements. You are an investor with a long-term plan, operating with incomplete information in an uncertain world, making the best decisions you can with the knowledge you have. Some days the market will agree with you. Some days it won't. Your job isn't to be right every day. Your job is to be rational every day. The stoic investor doesn't ignore 20% crashes because they don't care about money. They ignore them because they care about money too, much to let emotions destroy their wealth-building process. They understand that the path to extraordinary returns runs directly through ordinary volatility. INTU will recover, or it won't. But your character as an investor, your discipline as a decision maker, your wisdom as a student of markets, these things compound regardless of what any individual stock does on any individual day. The crash reveals who you are. It doesn't determine who you become. Knowing the principle isn't enough. The next video shows exactly how to apply it.